Hello, everyone, and welcome to a discussion that we're going to have with Anthony Brister. He's an asset protection attorney who also has his LLM in tax and does a lot of great tax work as well. Anthony, thanks for joining us today.
Thanks for having me, Chris. And I'm excited to talk to you guys about asset protection and some tax planning today.
Awesome. And I'm Chris Johnson. So I'm the owner of Johnsen Law. We have an asset protection practice here at the firm. Anthony helps out with the majority of that. One of the reasons that I brought Anthony aboard to help out with asset protection and tax was because it just drove me crazy all the stuff that I'm seeing on social media. I mean, left and right clients would send me this video of this guy on Instagram or TikTok. And my clients, they're pretty savvy business people. They had a gut for like, this probably isn't right. But I think a lot of what you see on social media, there's this fear of missing out. Like, oh my God, what am I missing? What am I not doing right? And so I see a lot about trust and I get a lot of requests about trust. So, first of all, it there's difference between types of trust. And Anthony, why don't you just kind of talk to us about the types of trust, how they actually work, because there's a lot of different kinds, and some do things and some do other things. And then I want you to address whether you use any type of trust in your asset protection strategies.
Yeah. So typically we've got two different types of trusts. And, one of them, maybe 1% of people will use. The other type, about 99% of people will use. And so we've got revocable living trust and then irrevocable trust. Revocable living trust, that's the one that mostly everybody should use. And the sole purpose of a revocable living trust is to avoid probate. It's used for estate planning. Revocable living trusts do not provide asset protection. Most people get that confused. They want a trust because they think I'm going to get asset protection by putting it in a trust. 99% of you are going to be using this other type of trust because it offers inflexibility.
Mm.
There's some tax benefits, but really, when we hear trust, a lot of the time we're talking about a revocable living trust, and that's used for just estate planning purposes and to avoid probate when you pass away. The other
Right.
type of, or
Go
sorry,
ahead.
go.
Hey, the way I like to think about it is revocable is I can take it back. I can change it. It's revocable because I still have control over this thing. There's no asset protection. Irrevocable, I can't take it back. I can't undo it. I have no control over it. And because I give up this control, I get some level of asset protection. Go ahead, Anthony.
Yep. So exactly right. The second type of trust, which again, most people probably don't need, is the irrevocable trust. And it sounds exactly like it is. Once you set that in place, you can't change it. Now, a lot of people try to come up with some schemes that they put it in a trust. They might even label it as an irrevocable trust.
Mhm.
But if you've got control over it, if you can change the terms in the eyes of a court, if you're ever in a lawsuit, they're not going to respect that as being irrevocable and give you that asset protection. So I do use irrevocable trust for some of my estate planning clients for asset protection purposes, mostly with life insurance. So there's irrevocable life insurance trust. And then if you're over a certain amount of net worth, it's really good for estate planning to get those assets out. But again, we're talking you need to be 30, 40 million plus net worth for these to make sense. Otherwise, we like using other estate planning tools, even if you've got an estate problem, before putting that in the trust, because most people don't like to give up control of those assets, especially while they're living.
So Anthony, so I'm a client and I'm calling you, and I'm worth 1,000,000, 2,000,000. I've done well, and I'm seeing all this stuff on social media, and I call you, and I'm like, I want to put my property in a trust because, or maybe a business in a trust because I heard that you should control everything and own nothing. So what are you gonna tell me? What are your thoughts on that?
Well, I think that's right. You shouldn't own anything. Your revocable trust should own it so you can avoid probate. But I feel like that can be misleading because, again, you're not getting any asset protection by putting that in a revocable trust. Again, under 30 million, you probably want to avoid the irrevocable trust because life happens, things change. Once you put that in the trust, you're not going to be able to get it back. So if you ever have any type of need for or funding or any type of exercise of control over those assets, the irrevocable trust is not going to do you any good.
Okay, and you're a tax guy, so tell me how are revocable trust tax versus irrevocable trust?
Yeah. So revocable trusts are see through, meaning that the tax benefits that happen under that trust are as if you own it. So they show up on your personal tax return. Whether you have an S corp, a disregarded LLC, which just means you own that LLC 100% and you haven't made any tax election, all of those assets flow through to your personal tin. An irrevocable trust files its own tax return, and those rates for a trust are a lot more condensed. So typically around 12,000 of income in an irrevocable trust, you're getting taxed at the highest rate. So again, when you're using irrevocable trust for tax benefits, especially on the federal income side, a lot of people will come out behind because they're not at the highest bracket. And if they're using this trust, they might be cheating themselves out of those marginal brackets and the rates in between there.
Okay, and so I'm gonna walk into one of the things you like to use, but before let's close the chapter on trust. What's a domestic asset protection trust and what's a foreign asset protection trust, and when might it make sense for someone to use one?
So a domestic asset protection trust typically makes sense for people in those states that do not have a huge homestead protection law. And this doesn't work in every single state. So you need to make sure if you are looking down that avenue to make sure one, your state respects those. States like California do not respect the domestic asset protection trust. So, you want to make sure to consult with an attorney either licensed there or familiar with those trusts and what states do not and do give you that protection. Foreign asset protection trusts, they put assets using foreign jurisdictions. Generally, you want to get those out of the US. Again, these are for people who are higher net worth. Again, we're talking 30, 40, 50 million plus. Again, there's heavy IRS scrutiny. When we're talking about this, you want to be careful to follow all the formalities and the rules and thinking about control. If you exercise control in any format and you get into a lawsuit, those assets can be clawed back. But again, they're good for asset protection, but for your everyday Main Street American business owner, probably doesn't make sense.
Why don't you tell us what you think makes sense for most people that are at a certain level of net worth and require some asset protection and some tax mitigation.
Yeah, so I think, there's different levels, right? If you're making 100 grand or less, maybe 50 to 100 grand or even 250, I think an S corp, having your operational business in an S corp makes sense, right? You can pay yourself a salary and then you can take distributions, avoid self-employment tax, which is that 15.3 Social Security Medicaid tax that you pay when you're self-employed. Those work very well for business owners in that area right there. Also, if you've got rental properties, things like that, and let's say you're under 5 million net worth, states like Delaware, there's some other states that have charging order protections. You can form an LLC as a holding company there, and then wherever your property is, you form an LLC there. That way, you have charging order protection. And all a charging order protection means is if there's a lawsuit against you, they can't come in and take those assets from you when you're personally liable. Now, when you're over 5 million plus, 10 million, 20 million, I really like using family limited partnerships because they provide a lot of flexibility. They give you that same asset protection and charging order protection. There's really a lot of flexibility in the way you can assign income using family members. If you support family members, you can shift income to them, use their tax brackets to pay for their everyday living expenses. I like using C Corps as a general partner. So you can do some stock restrictions, have voting proxies, and also have a succession plan through a control agreement.
Okay, that's good. Why don't we get into the nitty-gritty of a family limited partnership? Is there any way you can just really dive down and explain, what it is, how it's structured, and then maybe, step by step, maybe recap some of those benefits that you see that can be used?
Yes. So I'm just going to share a little simple chart that I like to show with clients as we're going through and thinking about asset protection and estate plan. So this chart right here represents a family limited partnership, and we have your operational S corp here on the outside.
Wait,
Family
so
limited
you
part.
you just called it an S corp, but that operating business is an LLC. Why don't you explain to us why you're saying that?
Yeah, so most people don't know this, but an LLC can actually be taxed 4 different ways. You can have a sole proprietorship, which means there's only one owner in that, and that's taxed on your Schedule C. Or if it's a rental property, it could be on your Schedule E. That means it doesn't file its own tax return, and everything shows up on your personal tax return. When you have two partners, the default is a partnership
Mm,
for an LLC. Now, the other two options, you actually have to make a election with the IRS in order to be qualified as these, but the LLCs can also be taxed as an S corporation or a C corporation. The S corporation is again what most small business owners probably should be using. The benefits of that is you can avoid self-employment tax on active income. When you have
yeah,
a partnership or a sole proprietorship, all of your earnings are being taxed at that self-employment tax
well,
on your first 160,000 of income.
and that was the first suggestion you made, that pretty much anyone that's in business should have this structure, which I just want a clarification on that. So it's probably in its electing S corp status for taxation purposes.
I say mostly everybody, so it makes sense once you're probably over 40 to 50,000 net. Anything below that with an S corp, you actually have to file a separate tax return.
Okay.
So there's some administrative costs where, under 30, 40,000, 50,000, it might make sense just to be a sole prop or a partnership until you grow that business so you don't have that added complexity. But
Okay.
once you're over that, the self-employment tax savings really make up for it by choosing the S corp election because again, you pay yourself a small salary that needs to be reasonable, and then you can take distributions on the rest of the income and avoid the self-employment tax, right? And when we work with our business owners, we always look at your net income, what kind of roles you're doing in that. We come up with a reasonable salary and a distribution portion to make sure that you're paying yourself small enough salary, but reasonable enough to where you don't have audit risk. And you're also taking those distributions in order to save on self.
That's great, Anthony. Thank you. Sorry I got you off track.
Yep. And then lastly, the last way an LLC can be taxed is a C corporation. Again, small business owners, with the exception of a few items, should not be operating out of a C corp. C corporations are generally for companies that are going public, that plan on selling. They provide manufacturing, things like that, and they're really growing. For a small business owner, C corp's probably not your ideal way because the only way to get income out is either through double taxation or paying yourself a salary, which is subject to the full self-employment tax, the Social Security, the
Yeah.
Medicaid tax at 15.3%. If you
Yeah.
go down double taxation route, You have to pay corporate tax, which currently is 21%. And then to take out earnings after that, you have to pay the dividend tax rate. So you end up being at a lot higher rate than if you were even in just say sole proprietorship. So that's a S corp. Going back to the family limited partnership, when we're talking about limited partnerships, there's two types of partners that you need to be aware of. There's a limited partner and a general partner. Limited partners, the only risk that they have is the investment in the limited partnership, as long as they're, following the rules and formalities. However, they don't have any control. On the other end of the spectrum, we have a general partner. General partners carry all of the risk and they also have all of the control. So we generally like to use an entity, whether it be a LLC, tax as a C corp, or just a C corp as your general partner, so that you're not carrying unlimited liability for anything that goes on inside your limited partnership. Limited partners, that'll be yourself. When we're talking about family limited partnerships, we like putting family members in there for reasons we'll go over here in a second. But this tool is really used for asset protection and estate planning and the tax benefits as well.
Do I have to have family member in here?
You don't, but to have better asset protection, we do like to break up ownership. So it doesn't have to be a family member. It could be close friend, business colleague, whoever it might be, but it works a lot better when you break up ownership while maintaining control still through stock restrictions, voting proxies. So you do get a lot better asset protection when you're breaking up ownership, but we don't like to give up control and we keep control
Got
through, the restricted stock and shareholders agreement. If you don't
got
have
it.
anybody,
Okay.
you can still have an LP. It just might not give you as much protection depending on which state you are and whether they have the charging order protection laws.
Got it.
So with this limited partnership, which is this box right here, what it does is it just holds assets. So it doesn't do business. It doesn't sign contracts. It's just strictly there to hold cash, other LLCs, and then to distribute income or to take in cash, from personal savings or investments, things like that. This is where you want to storage your wealth. So I think of the limited partnership as a savings account almost and a holding company. It either holds LLCs or liquid investments that do not carry litigation risk. So, if you're going to invest in an apartment building, something like that, to where there might be litigation between you and third party or the person who got you to invest it, you don't want to hold that directly in the LLC. Or the LP rather, we use LLCs as risk management tools to hold risky assets. So whether it's an operational business, a family cabin, Airbnb, long-term rental, something like that, we put that inside of an LLC, which is owned by the LP. By
Okay.
doing that, you get all the benefits of the LP or the LLC while maintaining the benefits of a limited partnership.
What about that S corp? Is that owned by the limited partnership?
So S corps can only be owned by other S corps, a specific type of trust, individuals. So LP cannot own the S corp. However, we have this. If you look here, we've got a management services LLC. So the way
Yeah.
that sometimes we get income into the FLP if we don't have passive investments is through a 1099 agreement from your operational business to this management services LLC. And we just contract out at arm's length rate some services that you're probably already providing for your business and pay this LLC here in order to get income in. So another benefit of the limited partnership is the estate planning part of it. First off, by using the limited partnership, you're consolidating your assets into one place. So from an estate planning point, most of your assets will either be in your operational business or in your limited partnership. So you pass away, there's no asking, where is this titled? What's this owned? Your LP owns all of it. And on top of that, when structured properly, you get what's called an estate discount. So for estate tax purposes, for those people who currently right now the exemption is around 24 million. So remember we talked about using an irrevocable trust. Well, if you're 10 million to 24 million, the FLP is a good middle ground for you because you don't give up control. The limited partnership is very flexible in that you get some of the same benefits of an irrevocable trust, like the estate discounting, but you maintain full control while you're living. So it's like a irrevocable trust in that you get estate planning discounts and you also get asset protection, but it's also like a revocable trust in that once you put stuff in, you can take it back out if you need to, and you still have control over it.
That's a good way to put it.
And, while we're talking about it, your revocable living trust, if you do have it, would own your shares and your units of the limited partnerships. Because if you just own these in your personal name, these assets would have to go through probate. So I always think it's a good idea to use a revocable living trust to own your units so that you are avoiding probate.
Right.
So, just as a recap, family limited partnership, we've got limited partners, general partners. Limited partners have no control. They carry very little risk, only the risk in their investment in the partnership, while general partners are the complete opposite. They've got all of the control, but they also carry all of the risk. So when you're using a family limited partnership, you generally want your general partner to be an entity and not a person. We use limited partnerships for estate discounting. People generally 5, 10 million, 20, 20 plus. Once you start thinking over 30 million, we might want to use a family limited partnership and an irrevocable trust in tandem. From there, you're able to shift income from yourself to family members who are also partners, limited partners, and your partnership. And we use LLCs owned by the limited partnership in order to put assets in there that carry risk, whether it's apartment buildings, passive investments where a third party, you're investing with a third party, and we use the management services LLC to drain some income from your operational business over to your FLP if that's needed.
Got it. Oh, well, let's talk tax a little bit. You said revocables pass through, irrevocable steps up really fast to like 40%, which is no bueno. So what happens here with the FD?
Yeah. So the way that we have this structured here, typically I like using a C corp for the general partner. So this entity here does have to file a tax return. If you're using a C corp, it will be a corporate tax. So it'll file an 1120 tax return. Generally, we don't have any activity at all, if any, in there. So it should be a very simple return, zero return, or minimal activity there. And the limited partnership, since this is a partnership, it has to file a 1065, which just means it files its own tax return. And then the owners get a K1 at the end of the year. And it's the job of the general partner to decide how income is split up. So if you make $100,000 in this partnership, the partnership doesn't pay taxes. It's a combination of the partners that do pay. So each year, depending on its distributions or how the general partner wants to allocate income, this 100,000 gets divvied up between these partners here.
Okay, so how does that work if we divvy up some income to a child, for instance?
Yeah. So benefit of using this in a child is, let's say you've got a kid in college, right? Well, most people, the way they pay for their kids' college is they use their after tax dollars to either fund a 529 plan or just to pay for those kids' expenses after. So you're using, if you're the highest bracket here in Texas, is 37%. And let's say you're in a state like California, you might be at a 50% bracket. So in order to pay 50,000 in California, you have to earn 100,000. Instead, we like using the limited partnership to allocate income, which means instead of the money coming to you first and then you giving it to them, they get that money directly from the partnership to their own bank account and they pay taxes at their own tax rate. So instead of using, a 50% bracket or 37% bracket, kids in college earning around 60,000 with credits, things like that are probably around a 6 to 10% bracket. So from
Mhm.
a family wealth standpoint, you're saving 20, 30, maybe even 40%. And so from a family cash flow perspective, you're coming out a lot ahead while using those same dollars in income each year.
That's amazing. So let's just talk just generally about we don't need to go into all the details of what's required. That's just too much. But is this a lot of work to set something up like this? Or is this just like a few little filing?
So, it does take some groundwork. Now, I wouldn't say it's a lot of work, but I will say if you're somebody who doesn't follow rules, who isn't neat with their corporate maintenance, this structure might not be for you. For each box here that we see, it is its own separate entity, which means you have to have a set of books for each entity, a separate bank account. Each bank account needs to be adequately funded and all of those corporate formalities that we go through. But really, once we set it up, it's not much. It's just you're moving the money with an additional step than, let's say, an S corp, right? Typically, the way you get paid in an S corp, someone pays you in your business, and then you can either take a W-2 salary or you take a distribution straight to your personal bank account. Here, we're adding one layer, which is the limited partnership acts as a middleman in that it goes LLC to your limited partnership to yourself. And again, though, we like using that limited partnership to as your savings account and storage of wealth. So, really to the extent that you're not using cash, you probably want it in that limited partnership.
I like it. Okay. So let's talk about risk. And I heard you talk about this before, Anthony. You called it inside risk and outside risk. I might have a little bit, but I think you know what I'm saying.
Yeah.
So can you talk about those different types of risk and how the FLP structure protects against each?
Yeah. And, let's talk about the FLP, the LLC, and then a irrevocable trust, kind
Okay.
of all this, right? So let's talk about inside protection first. What inside protection is the operational risk in your business. So, a rental is a very easy example. In a rental business, your operational risks are trespassers coming into your property or tenants. So, let's say a tenant trips and falls in your rental property. In an LLC, that gives you inside protection in that if you're following the formalities, the most that they can get if something happens in your LLC is whatever is in this LLC. So if you have a fully paid off house, or if you've got 10 houses in this one LLC, if there's a civil lawsuit, anything in this LLC would be at risk. So that's what an LLC does is prevents it from going into your personal assets after everything is exhausted in that LLC. So that's how it
Right.
gives you inside protection. An FLP works the same way in that, again, the LP doesn't do any business. So we carry anything that has inside risk in an LLC. So if something happens in one of these, your personal savings, your stocks, your brokerage accounts, your other lines of businesses aren't going to be at risk. Same thing with the irrevocable trust. If you have an irrevocable trust out here, something happens in that irrevocable trust, the most that they can get is whatever's in this irrevocable trust. So the second type of risk is outside risk. And this is really your personal negligence or liability. So I like using an example. Most people drive a car. If you're driving down the road, you get in a multi-car collision. What outside protection is anything from this outside not being able to come into the businesses on the inside. So with an FLP that's structured properly, we break up ownership and we have charging order protections so that if something happens out here, they're not going to be able to come into here or into here because we've got that protection. We broke up ownership and we've got the charging order protection. So you get in a car wreck, Chris gets mad at a bar one day, hits someone in the head with a bottle. He's not his personal assets aren't gonna be at risk as long as
Yeah.
they're in the FLP.
Yeah. Yeah. Which is huge because we're always thinking about, policies on our cars and our boats and umbrella protection and all that kind of stuff. And providing the protections in the same type of thinking.
Yep. And, sorry, umbrella policies actually don't
Yeah,
protect against your own negligence, and most people don't know that.
that's a good
So, it actually does protect you and your own negligence.
that's a good point. That's a really good point. Anthony, what about bankruptcy? What if I file bankruptcy? What happens to my interest in the LP?
So, bankruptcy doesn't give you personal bankruptcy if you're the owner here. It would be considered in your bankruptcy as assets. Now, if you have a limited partner here that files bankruptcy, typically the way I draft my agreements is that the limited partnership where the corporate general partner has a right to reclaim those units so that you are protected in. But if you are claiming bankruptcy yourself, that that's not gonna be able to escape that. Same thing if, let's say, you already have a lawsuit out against you, we can't go form an FLP or a limited partnership to the because court would consider that a fraudulent transfer and not respect it.
That's very helpful. Anthony, is there anything else you think we should address regarding the structure?
No, not really. I just, wanna get in, like we outset that there is a lot of information out there, especially on social media, from people who aren't licensed in the law. So I would just be wary of getting advice from social media lawyers. And
Anthony?
yeah, still
And
here.
one of our connections froze up. Let's do that one more time and you can even kind of wrap it up, okay?
Okay.
So Anthony, that was very helpful. Is there anything else that you think we should address or discuss today?
No, I think that covers it very well. I just want to emphasize again, like we said from the beginning of this video, if you're concerned about asset protection, don't trust your social media lawyers, especially those who don't have a license. Consult a licensed professional about this because if you make a misstep, you might have an LLC or you might have a trust, but it might not be giving you that same protection that you think it has. So it's always really important to find someone who's licensed and, well vetted and has their license on the line to give you this advice and make sure that you are fully protected.
Thanks, Anthony. And thanks for all the information. I think it was really helpful going through the spectrum of, revocable, irrevocable, hybrid middle ground of the FLP, kind of how it works, the advantages to it over the other things, how we integrate a revocable trust into the overall plan. Very, very great information. Thank you so much, Anthony.
Yeah. Thanks for having me, Chris.